the Executive Director of the Australian Chamber of Commerce in Korea. It's my pleasure to introduce you to today's webinar, Economic Outlook with IFM Investors. With a modest surplus of 4.2 billion Australian dollars, the recently announced 2023-2024 Australian federal budget is set to place significant revisions across a wide range of areas, including corporation tax, banking, superannuation, infrastructure, healthcare, defence, and more. To provide attendees with a snapshot of the broader Australian economy, its outlook, and what it means for industry and business, we are joined today by IFM Chief Economist Alex Joyner and AustCham Korea Board Member and Director and Branch Representative of IFM Investors Korea, Kelly Lee. With that said, I'd like now to hand it over to Kelly Lee to provide a quick introduction into IFM Investors Korea. Kelly, welcome.
Can everybody see the screen? Okay. Yeah, so a quick introduction to IFM Investors. IFM Investors is a global fund manager owned by a group of 17 Australian pension funds known as Industry Super. Our largest shareholder is Australian Super, followed by many that you can see on the screen here, such as Chivas, Hesta, Hostos, and 13 other industry super funds. We work in the Australian private sector. Just to put in context for you, chances are you are a member of one of our shareholder super funds shown here. And by virtue of that, as part of your super contributions, they are most likely also being invested by IFM Investors. And our company name also reflects that, as IFM stands for Industry Funds Management. IFM Investors has USD $145 billion under management across 4 asset classes that you can see here. Infrastructure is the largest component at around 70 billion, followed by debt investments, listed equities, and private equity. Our unique pension fund ownership structure aligns the interests of our investors and ourselves as a fund manager, meaning that it allows us to focus on maximizing net investor returns for our investors in a responsible manner. Around 650 institutional investors we invest on behalf of. They are some of the largest pension funds and aligned institutional investors across 25 countries. Through our investments, our purpose is to enhance the retirement savings of millions of workers around the world and also contribute to their communities by investing in businesses, providing credit, owning critical infrastructure, and creating jobs. We are the largest pension fund-owned fund manager in the world, and we currently have 10 offices globally in Melbourne, Sydney, New York, London, Berlin, Zurich, Amsterdam, Tokyo, Hong Kong, and Seoul. And one very recent development that hit the press this week is that we had a change in our board chair. Our current chair, Greg Combe, was appointed earlier this month by the Albanese government as the new chair of the Net Zero Economy Agency of Australia. Last but not least, a quick word about IFM's Korea business. I was brought in to establish the Korea branch back in 2017 as the first staff member. And 6 years on today, we are a team of 4 people, and we currently manage approximately $2 billion in global infrastructure investments on behalf of 17 Korean institutional investors. So that's my introduction to IFM Investors. I will now hand it back over to Rowan. Thank you.
Thank you very much, Kelly. It's impressive to see the size and scale of IFM Investors, and especially in the expertise that you with infrastructure and funds. Now, to introduce Alex. Alex has 2 decades of professional experience in economic and markets. Alex was the chief economist at the Bank of America, Merrill Lynch, and previously to that, he was a senior economist with ANZ Bank. Alex joined IFM Investors in 2016, where he has been the chief economist ever since. Honest to have you, Alex, and thank you very much for taking the time to provide some insights and the outlook into the economy.
No problem at all, Rowan, and appreciate the invitation to speak to the chamber. I haven't been to Korea, obviously, since the start of COVID. I did get there a few times beforehand and have been there in my previous roles. And I often speak to groups of Korean pension fund representatives that visit us down in Melbourne. And what I intend to do is take you through a very quick but perhaps detailed in the content of the slides, but a quick overview of just what's happening in the world economy and just how that relates back to Australia. There's a lot of material here. I'm certainly open and happy for people to ask questions when they see fit and don't necessarily have to wait to the end, or contact me after the presentation and share some thoughts and see if there's any questions through that avenue as well. So where we start is really where I start. I'll skip over some of the words because you can read them yourself. I don't have to sort of go through those dot points. But where I tend to start is just a geopolitical background that we have at the moment. Obviously, tensions are running relatively high with the Russia-Ukraine conflict. But also, I guess, one of the things that we tend to look at from a long-term investor perspective is just the shifts in the global economic order that we've become relatively used to, I guess, through the period in particular between the global financial crisis and the pandemic, that are increasingly coming under pressure because of some of the geopolitical tensions, and probably, if anything, they've accelerated because of the Russia-Ukraine conflict. And geopolitical tensions are high. You can see that in some of these charts on the top row there. Economic policy uncertainty is high. I think that is born less from geopolitics, but more out of just what's happening with supply chains, what's happening with global monetary policy, cost of living pressures. These are all themes that are woven through this presentation. And increasingly, the theme is detrimental to global trade and global investment. And you can see the top right-hand chart there on the first slide. Under the global economic policy uncertainty is uncertainty around trade. And that rose very sharply leading up to the pandemic because of tensions between the US and China, and is now just ticking up a little bit. Now we've passed through the worst of the pandemic and its after effects. It's starting to tick up again as we see those trade tensions bubbling to the surface. The bottom set of charts underscore this theme. Globalization probably peaked some time ago in the amount of goods flowing around the global economy. Increasingly, there is talk of reshoring, particularly manufacturing capability, as supply chains were put under pressure through the pandemic. That's a narrative that continues and continues to sort of shape some of the industry policy of many countries. There's obviously particular reference there to sensitivities around technology, chip making, those sorts of industries, obviously notable for Korea, where the US and China are certainly not seeing eye to eye. Where it impacts a little bit more for, say, a company like IFM is FDI flows, and what we're seeing in the IMF went into this in some depth in their recent World Economic Outlook, is that increasingly countries invest in those that have similar values to them rather than those that are particularly geographically close. And that's something that has defined IFM's method of investing, and I think is a thematic that will guide it over the coming decades. To get through to some of the economics, this is quite well known. Inflation is a problem. It is a particular problem depending on what country you're in. So most of the supply chain impact has come off in terms of not being able to get goods. It's just at what price. Those prices are declining in the goods space at least, and we're starting to see that come through in inflation measures in many advanced economies where goods prices are coming up. Well, goods inflation, I should say, is coming up quite sharply. Where some of the problem lies now is around services, and these are usually domestically generated pressures. But all in all, it's a situation where the inflation fight is definitely not over, and central banks are pursuing inflation as best they can. The problem with that is the only way they can do that is through weaker economic growth. And this is some of the high frequency, I guess, analysis that we put forward on some of the manufacturing survey indexes, some of the non-manufacturing indexes from the PMIs. And it really is telling us a story where global growth is slowing down in many countries. Now, that is largely due to the tightening of monetary policy, but also cost of living pressures. High inflation means real economic growth is impeded quite significantly. I guess it's the advanced economies of the world where we worry about recession most. The US hasn't entered recession. It's been a little bit more resilient, I guess, than many of us were thinking late 2022. But it is still favored to go into recession later this year. Germany and the broader Eurozone went into a very modest recession late last year and into this year. That actually came through not in the initial data, but in the revisions of that data, just showing just how the Russia-Ukraine conflict was impacting through the energy space, in particular, countries that were so close. Whether we get recession or not, I think what is assured is very much below trend growth. Below trend growth in 2023 and below trend growth in 2024. And that's really what sets us up for some pretty challenging years in the global and Australian economies. The bright spots there are in the emerging market countries, which is the bottom right-hand chart. That's just a chart of the probability of recession according to market economists. Many of the larger economies of the world are not susceptible, seemingly, to as marked a slowdown as the advanced economies of the world. And that's largely through inflation dynamics. Now, their growth will be weighed upon just by what's happening in the advanced economies in the world, like the US, Eurozone, UK, and some of the smaller countries, Canada, New Zealand, Australia. If they slow down, then the other countries, the exporting and producer countries of the world, will also slow down. The reason this is happening is because fiscal policy is tightening up, or at least winding back some of the expansionary settings that were through the pandemic. And there's a huge tightening of monetary policy. I say that not only the rise in interest rates that you can see in the bottom left-hand chart, but also the winding back of central bank balance sheets, removing liquidity from markets. And that's a thematic that is, I guess, particularly interesting from an investment perspective, but also from an economic perspective, where money is coming out of economies, credit is tightening up, and that's being exacerbated by some of the global issues that we're seeing, or that we saw earlier in the year around banks in the US, some banks in the Eurozone being under pressure as that flow of liquidity from central banks evaporates and starts to recede. A lot of the slowdown that's happening in advanced economies, and that is going to happen in Australia, is coming through the household sector. Consumer confidence was very, very poor late 2022. That was really the peak pessimism, if you want to put it that way, of the household sector. You know, that was when inflation was accelerating and we didn't know where it would stop. Real wages were going backwards very sharply. Dwelling prices were increasing in dwelling prices were decreasing in many economies around the world, and a high level of indebtedness, particularly in countries like Australia, meant that that threat of interest rates was a very real one. On top of all that, the way that monetary policy is transmitted through the economy is to slow them down, and that would more than likely result in an increase in unemployment rates. Now, that hasn't happened to the extent that we thought it would late 2022, but we still expect it to happen because inflation is proving a little bit more sticky in many jurisdictions, and that will simply result in central banks being more aggressive to slow economies down, and that's what we're seeing in many cases, including in Australia. Some of the structural impediments to economic growth are still there, most notably productivity growth, but higher rates of debt, lower rates of investment are all meaning that we just grow in the global economy a lot slower than we did leading up to the global financial crisis. GDP per capita in particular has decelerated amongst almost all advanced economies due to that dearth in productivity growth, and also in many countries, the demographic shifts where people are exiting the labour market and participation rates have downward pressure as the population ages. Now, Australia is a little bit different, and that's what I'll get onto in coming slides, but that's really the narrative that's causing some of the tension, I guess, in the global economy, is that, you know, economic growth was not great to begin with. And, you know, the pressure that central banks are putting on it now means there's not much leeway, I guess, in terms of having capacity to slow economies down without recessions. China is a little bit different. It is targeting 5% economic growth this year. Tends to grow at that rate that the government defines. I think the data has been a little bit choppy and a little bit inconsistent, so it gives rise to the thinking that the Chinese authorities will stimulate their economy, whether that be by traditional means like infrastructure spending or through loosening lending to the household sector. That seems like it's going to happen, and it's already started happening, in fact. So China is a little bit of a bright spot, and as I said, but if the rest of the world slows down, then China has those pressures on it, and it has to have domestically generated growth. Now, usually that's good for Australia because there's a demand for resources. The thing that is a little bit, I guess, uncertain still is just how Chinese tourists will come back. Chinese movement around their own country has picked up to pre-pandemic levels, but certainly movements outside their country have not picked up to pre-pandemic levels. IFM sees that. We own large portions of the airport sector in Australia, and we certainly haven't seen the Chinese tourists come back. We certainly have seen Chinese students come back, but certainly not that tourism side. So that would be a little bit of a boost to growth, particularly to countries like Australia, where that was quite the tailwind heading into the pandemic. So these are charts just on the four larger economies in the world, and it's what I've done here is I just look at the economists, an economist that sort of looks at economists as well. So this is the market economists, and they get surveyed by Bloomberg every month, and this is the evolution of those forecasts. And what you can see is the peak pessimism on the top four charts, which is the real rates of GDP growth. You know, the blue line, which is 2023 expectations, has picked up a little bit. So, like I said, peak pessimism was around the latter part of 2022. Things are picking up a little bit, but they're certainly not good. It's very weak growth, just not recessionary growth in many countries. The US is probably the standout here, where that's picked up a little bit, but we still expect a very shallow recession in the latter half of this year. But the reason that line picks up a little bit is because we've had some unexpectedly good growth in the US at the start of this year. So the expectations of that recession sort of bleed into 2024. And then it's the inflation story, and just how quickly we can get that down in many of the economies of the world. Now, that is highly uncertain, and really defines growth going forward is how inflation will come down, and will it come back to central bank targets? Because we know that if inflation isn't coming back sustainably to central bank targets, then central banks will not cut interest rates to support economic growth, and that's what we really need to see before those 2024 expectations pick up at all. I guess the energy transition is a theme that we talk about a lot as long-term investors. From that economic perspective, is it going to move the dial in the next few years? It seems unlikely. We know there's a lot of investment that needs to take place both in Australia and globally in the energy space to get things where we want them to be, heading towards a net zero future. It is a bit of a wild card, but it seems to me in the next at least sort of 12 to 18 months, not too much is going to happen on that front, and you might draw that out to the next 3 to 4 years. Moving to Australia, we're a little bit different, but still facing a very challenging period. Australia differentiates itself via two key channels. One is the ability to attract people, to attract population growth, and the other is our resources side. Population growth has rebounded extremely strongly from the decline that we saw through the pandemic where the borders were closed. That has continued, and that really is the driver of growth that differentiates us. Our economic growth is not because we are so much better, but it is because we are bigger by virtue of net overseas migration. Now, a lot of that is overseas migrants coming to Australia, but it is also by virtue of the fact that not a lot of Australians are leaving. So the net number or the net inflows to Australia are very, very high, and that sort of masks over our extremely poor productivity performance, which has characterized the Australian economy for that period through from the GFC to the pandemic and most advanced economies. Another thing that patches over that is our resources wealth. I characterize this as being, we've had two terms of trade peaks. The first one in 2011 was described as a once-in-a-century event. We've had it occur twice in a decade. And this is even a larger peak than we saw in 2011 because we've got the curious situation of very, very high US dollar denominated commodity prices and an Australian dollar that is relatively low. The Australian dollar is sort of in the high 60s at the moment with these extremely high commodity prices. Back when they were extremely high in 2011, 2012, we had the Australian dollar above parity with the US dollar. So in Australian dollar terms, the revenues that have been coming to Australia have been extremely strong, and that's something that's had a budget impact most notably. Just going through some of the GDP numbers, it's been a slowdown, but not a collapse as yet. We are expecting much slower growth. Australia has been overly reliant, I guess, on the public sector for economic growth in the years leading up to the pandemic. That sort of needs to change. But it's really the household sector that's under pressure with rising interest rates and the cost of living really going to put some downward pressure on household spending, which is about half of the real economy. Dwelling investment, so the construction cycle is also very, very muted, and we expect it to continue to be. So there is really nothing out there that would suggest the Australian economy should do any better than, say, the rate of population growth. That would be the best case scenario. Most people expect a per capita GDP recession, and it is actually implied in government and RBA forecasts that will take place. It will get a negative growth impulse on a per capita basis. A little bit of the positive has been our labour market. The labour market has been very resilient so far to increases in interest rates. It's also been a bit of a global narrative. The US labour market has been pretty good as well. We've really outperformed, I guess, in terms of the size of our labour market, which again is something that boosts our economic growth. But these things are going to unwind a little bit, and we're starting to see that in some of the labour market data here, where employment growth is starting to slow. We got a very big number last month that has supported that, but we know that is going to slow. We're starting to see some of the forward indicators in the labour market space come off. I guess one of the good things that we don't see in some of the other advanced economies like the US is that in Australia, we've recorded the record high participation rate last month and a record high employment to population ratio. So a lot of people in Australia are employed. That's a good thing as they try and weather the higher interest rate, higher inflation environment. Yeah, we talk about some of the population dynamics and just how they're feeding through. Basically, we've had overseas migration coming to Australia. That's boosted participation because we tend to bring in skills and people of a working age. That continues to happen. We've been able to offset largely the downward trend in participation that we'd expected. This is the bottom left-hand chart, with population aging by bringing in a younger age cohort and older people continuing to work longer, which has been pretty impactful on the participation rate actually moving higher. We've also had increased female participation for an exceptionally long period of time. And when you bury yourself in the data, it becomes apparent that a lot of the increase in participation has been older females. Skip that one there. This is pushing wages higher. This has been something that has been positive, I guess, from the perspective of individuals to try and cope with some of the pressures on budgets, on household budgets. Where it becomes a little bit problematic is what's happening on the inflation side, and the RBA is concerned that there will be some sort of wage price spiral. No extreme evidence or compelling evidence of that just yet, but certainly things like unit labour costs that I'll allude to later on have been rising pretty rapidly, and that's a concern from the RBA. Due to Australia's, I guess, a lot of inertia in the system of wage setting, we haven't had the wage breakout that we've seen in other countries, particularly the US, but they are building, and it's whether they can be sustained, I guess, in the face of the RBA tightening policy and loosening up the labour market. And we probably think that, you know, wages growth is around about to peak, probably around about that 4% before decelerating. A little bit more detail on just what's happening in the household sector. So obviously there's the real wage pressure that is obviously downward. House prices have been a very interesting one. House price growth has decelerated pretty rapidly in response to higher interest rates, as we'd expect. House prices have fallen from those 2021 peaks, but we're now starting to see a very gradual turnaround in house prices that I don't think anyone expected. And that's just because of very, very strong population growth, adding to demand in the property market where listings are very, very low. So there's not many houses on the market for sale. So there really isn't much to choose from, but a lot of people want a home, and a lot of people are finding it very, very difficult to get into the rental market. Rental vacancy rates are extremely low in Australia. So it's difficult to find rental properties. So people are going back to the property market despite higher rates, trying to see if they can pick up some sort of bargain there. The household income side, so wages growth has been good. That adds to people's household gross income. But when you look at household disposable income, that's really decelerating, and that's because what we're seeing is a huge amount of outflows into the mortgage space. So people paying interest on their mortgage has gone up very, very rapidly as people have come off fixed rate loans as well as just the floating rate rising. And that's going to be continued going forward, especially the people rolling off their fixed rate loans. And there is a situation where people are getting higher nominal wages are moving into higher tax brackets. So we've seen the rate at which people pay income tax increase to a well above historical average level. So household outflows from their gross income have increased pretty dramatically and haven't outflowed at this rate since sort of that 2001 experience. So it's a real challenge to the household sector. That's why their consumer confidence in that bottom left-hand chart is so low, sort of historically low, just sitting there, only lower in the pandemic and global financial crisis by a couple of tenths, as you can see in the bottom left-hand chart. People are obviously hugely concerned about inflation. And this is really what defines the household spending outlook to us, is that while consumer confidence is low, people having a job means that they can pay for goods and services. If there's increased job uncertainty, which we expect there will be, and we're starting to see that in some of the consumer sentiment numbers around job security, people are more than likely going to pull back on their spending, and that will see the broader economy start to slow pretty dramatically. Businesses have sort of held on pretty well until now in terms of current conditions. So, retail and things like that had been ticking over relatively well. Business conditions, this is coming from the NAB survey, which is probably the most prominent survey and is better than the industry surveys like the PMIs in the Australian context. Conditions have held up relatively well. It's somewhat ironic, I guess, that retail as a sector experienced the very, very best conditions that it ever has in the history of this series, going back to 1997, through the pandemic and in the aftermath of the pandemic, as people spent some of the money that they had saved or received after the pandemic when things opened up again. That narrative is now starting to pull back quite sharply. Confidence in the future has been pretty poor for some time, so businesses knew that that wasn't going to last forever. And now we're starting to see business confidence and conditions start to merge. And when that happens, we start to see investment pull back and employment pull back. And that's the concern for the economy, is that if businesses see no reason to invest and see no reason to employ, then things get pretty soft pretty quickly. What's the inflation outlook? Well, Australia's inflation is a little bit lagged, I guess, from the perspective of the global trend. It's true that we get our official numbers or our better numbers at a quarterly frequency, but we have been a little bit lagged in just how inflation has accelerated. But it is coming through on every measure. It is true that the headline rate of inflation has peaked in Australia, but the underlying measure, or the trimmed mean measure, whichever one you'd like to look at, is still not showing signs of peaking as yet. And certainly, there are pressures and differences in the Australian inflation context that may suggest that we will have our inflation taking a little bit longer to come down than other countries. And that's most notable against the US, where inflation is actually coming down quite rapidly. Australia might take a little bit longer, and that's the view of the RBA and people like myself. The reason for that is unit labor costs. So I did allude to the fact that productivity was very, very poor in the Australian context. When you mix that with wage increases, it's very difficult for businesses to cope with that and pass all that on to their own margins. So what they do is pass it on to the consumer. So nominal unit labor costs that have been accelerating recently look set to continue to accelerate, and that's something that's going to put pressure on businesses to put their prices up still and continue that upward trend of inflation. You can see on the right-hand chart, this is most notable in market services rather than goods prices. Goods, we import a lot of goods, so that it's not as impactful there, but services is obviously very employment intensive. So if wages go up, the prices of services tend to go up, and that's what we're seeing, and that's what the RBA is concerned about. We do have some other issues, and mainly they're encapsulated by the bottom 4 charts. Services, I've already mentioned that bottom left-hand chart. Administered prices, so some of these are around utilities and childcare, healthcare, etc. Some of these administered prices are just contractual prices, probably more accurately put. So, for example, my telecommunications bill came through. They just said that they were increasing my mobile charges and data charges by the rate of CPI. So, in a sense, high CPI is driving inflation itself now. That's something the Reserve Bank was always being concerned about. So, we're seeing a situation where, the Reserve Bank is seeking to break those inflation expectations. Utilities is one which is, I guess, particularly problematic in Australia as well. Obviously, we're a net energy exporter and apparently an energy superpower, but it is pretty baked in that we'll see electricity prices continue to rise pretty aggressively. There has been some rebates. The federal government gave some rebates to low-income earners. Curiously, I guess, working against what the RBA is doing, but in some populist politics, I guess, the Victorian government, so I'm sitting on a Melbourne background here, so I'm from Victoria, so I've seen this, have been offering rebates to all households, so not means tested, which has tried to cap some of those cost of living increases, but all in all, electricity prices will continue to rise, and gas is another one where things will continue to rise. And that will obviously put extreme pressure on household budgets. And surely there's going to be, as I've experienced myself, some bill shock as you get your utilities bills. Rents is the other one where we differ a little bit. Our extremely strong population growth has meant the rental market has tightened up extremely, well, to historical extremes. And the other part of this is just that household formation or household size has shrunk. Household formation has increased. And that was in the wake of the pandemic, where the RBA puts forward some very micro data on average household size, and that has decreased. So people not wanting to live in shared houses as much as maybe they were forced to through the pandemic, and that has put pressure on the rental space. Obviously, the number of houses being built is being weighed on by higher interest rates. So we've got a situation where rents are rising, and that will flow through to the CPI as well. So what's the RBA going to do about this? Well, it's been acting pretty aggressively. It's been quite difficult to pick what the RBA is doing, to be quite frank with you, from month to month. Certainly, it sort of caught a lot of people wrong-footed a lot of people when it paused a few months ago, only to resume its hiking in May and June. And the expectation is that it will continue to increase interest rates at least one or two more times this cycle, before I guess the market is at least expecting some decline in interest rates after that. In the meantime, obviously, mortgage rates and business lending rates are very, very high, and that is obviously putting pressure on those sectors. So I would suspect that the higher interest rates have to go, the sooner they will come down, but that's not necessarily a good narrative, given it will mean the economy has slowed down pretty markedly. I have included this one on the dwelling, some detail on dwelling prices. This is probably just for people's interest rather than to go through them. They are starting to turn around after some pretty spectacular growth recently. Most people are interested in house prices, so that's why I threw that one in, but I don't really need to go through it too much. Building approvals is one where that cycle has not collapsed, but it's certainly a very, very sharp downward trend, exacerbating problems around rental vacancies, and is under pretty extreme pressure in terms of the amount of people coming into Australia. Things around social housing are only sort of chipping away at the very edges of that, but we really need to try and encourage more building approvals, and this can be done sort of facilitated, I guess, through sort of that local, state and local government level, rather than just relying on the RBA to cut interest rates. But we're certainly in a down cycle, and we'll certainly have a situation where there's just not enough houses being built, and that's going to be something that defines Australia for at least the next 12 to 18 months. What's the RBA thinking? Well, this is their forecasts from their May statement on monetary policy. What you can see there is a shallow downturn, but the rates of growth are very, very low. and that is per capita recession coming through the household sector. There's been a bit of downside where the blue line, the actual, doesn't match up to the yellow line. That's where the RBA has been surprised to the downside on its forecasts. And you can see there, household income has been one in particular there. Dwelling investment's another one. A little bit of upside in business investment, which has been good, but there is an expectation that will come down. And there is an expectation that the terms of trade will come down, where it's been a little bit more robust, especially in recent months, than the RBA has been thinking. But all in all, it's a consensus view from the authorities that there is going to be a downturn. Just moving through the fiscal policy, I guess we're all surprised. I guess we recorded or will record, expected to record a fiscal surplus this year, insofar as the parameter variations. So basically, that's budget speak for forecast errors by Treasury, particularly around resources prices, but also the strength of the economy, wages growth, these sorts of things that add to the government's revenues. They all caught it by surprise, and we have recorded or will record a very small surplus. The government becomes a little bit more pessimistic in the out years, recording more deficits again. That's reliant on the terms of trade in particular retracing quite sharply, and that hasn't happened as yet. But that's just a conservatism that's usually built in now to most budgets. The government was pretty modest in some of the cost of living decisions that it passed through. There was a lot of debate in Australia: is this inflationary? Is it not inflationary? Is the fact that we go from surplus to deficit again inflationary? Look, I don't think it really makes a lot of difference. Technically, as economists, we would say going from a surplus to a deficit is expansionary fiscal policy, but a lot of this relies on the terms of trade in particular. So it's not something that is seen as something that is particularly meaningful for monetary policy. It's fairly neutral, and that's how the RBA has characterized it. We would expect that fiscal conservatism to continue. A lot of the debate in Australia now will shift to things like stage 3 tax cuts. There's talk about an aged care levy, some of the issues around household taxation, and the structural budget. And that's what you can see in the bottom right-hand chart here, where the Treasury, using a broadly accepted methodology, would say the budget is still in a structural deficit because we can't rely on the terms of trade and better economic outcomes to right the ship in terms of the fiscal metrics. But I guess the cyclical deficit would say that's been a very strong positive. But certainly the government, this government and previous governments have always put forward that there is a need for expense restraint, and the need to continue to push revenues higher. So that is probably the medium term budget debate in the Australian context. Where the budget always misses these days, and where fiscal policy, I believe, has gone missing, is just on productivity. There is very little being done, despite the Productivity Commission in Australia's best efforts to put forward ideas. Very little has gone into action on boosting productivity or allowing the business sector to boost productivity. So that's something that we could proactively use to raise living standards rather than relying on good luck. We'd rely on a bit of good management. And productivity is obviously, we talk about a lot as economists. It is the solution to many, many issues in the economy, from that unit labor costs issue that I spoke of earlier, but also to higher rates of potential GDP growth, which we all want if we want higher living standards. Quick slide on the Australian dollar. I guess unfortunate for those that are going overseas and trying to spend the Australian dollar, but good for people overseas coming to Australia or people investing in Australia. The Australian dollar is very, very low on a valuation, on valuation terms. The things that we usually use to get a broad sight on where the Australian dollar should be are commodity prices and the 2-year bond yield differential or some sort of bond yield differential in the Australian context. And commodity prices suggest that it should be much, much higher. Bond yields suggest it should be a little bit lower. And the Australian dollar is sort of trading in between. It's seen a little bit more as a risk proxy and a currency in which central banks use as a reserve currency. So it's trading a little bit different to its historical pattern. But certainly that chart in the middle, top middle, is really why Australia has been able to differentiate itself on the fiscal side of things. We just get such a boost from Australian dollar commodity price inflows, and that was evident in the previous slides on the fiscal metrics. I'll skip over this. This is sometimes useful for investors to get an indication of the Australian stock market and what makes it up, basically banks and mining companies. But this is the chart that I wanted to focus on at the end here. These are the market economist forecasts of Australia. You know, it's a situation where we are going to experience some pretty poor growth. 1.6, 1.7. It's higher than many of the other advanced economies in the world, but certainly when you look at the 2.1% population growth that we're likely to peak at, you know, it is still negative in per capita terms. And then I think the big uncertainty there is just how inflation comes down. To my mind, that might be a little bit optimistic to have inflation back at the target in 2024, and indeed the Reserve Bank itself suggests that it will be about mid-2025 before we see inflation back at the top of the target. And unfortunately, you know, we're going to see things like the unemployment rate start to rise. The market there is around about where the RBA is in terms of its expectations for unemployment. But certainly there's some upside risk in that space, given the large amount of labour supply and people wanting a job. It doesn't take labour demand to come off too much for that unemployment rate to go higher. So very challenging, I guess, is the global and Australian economic environment. And perhaps I'll leave my comments there, and happy to take any questions and maybe throw back to Rowan to curate those.
Thanks, Alex. That's a fantastic snapshot of the economy and its outlook. In wrapping up today's webinar, I'd like to thank Alex Joyner and Kelly Lee from IFM Investors and for their support of the Australian Chamber of Commerce. For those who are watching, thank you for joining us. For updates on other events, engagements, and activities, be sure to follow us on LinkedIn, Facebook, Instagram, and via our website. For now, thank you very much and look forward to speaking to you soon.